Peter.
Hey, Gary, how you doing?
Good, good. This is just the, here we are.
Nice to see you. How you been?
I'm really good.
Good.
Really good. Hey, the show's taken off, by the way.
Good, fantastic. How's the lighting, by the way? Is it all right? Do I need to put this thing up a little bit higher?
No, it looks good.
That's okay.
Yeah,
You can't see the dust. You can't see the dust on my printer.
Yeah. I was no, no, it's good. Yeah, so we had over 10,000 viewers of the last show, and I just got Guy Kawasaki agreed to do the show for me, and awesome. I reached out to Mark Benioff, who I know, he's my fraternity brother, and so I'm working with trying to see if I can get him to do it. So now things are good, actually. Everything's good.
Good. I'm glad to hear it. Hold on 1 second.
Yeah.
I'm gonna see if I can prop it up a little bit. Yeah, you know, I talked to Derek, and it's totally super easy, actually.
What's that?
This what do you call it? This app.
Yeah, the app is easy, and Peter, I got to tell you, the amount of reach, we got this stuff down globally now to be able to connect a lot of different sources together. It's amazing, actually.
So what do you want to talk about, by the way?
I don't know. I thought you were coming up with the ideas. I'm kidding. Now we're going to talk about, I like to keep things positive because they're so beat up with the current situation. And by the way, we may be live right now, so there may be people coming in. So I try to keep things upbeat and positive, and I don't focus on Russia at all. I talk about the global, environment. So we talk about, what's happening, what's the state of venture capital, how have things changed, the post-pandemic, what excites you, that kind of stuff. A lot of general things. And then we can get to the topics that, if you think are interesting. This does reach out quite a bit. So we sent out emails to about 100,000 people. Mm-hmm. So, I mean, the show's actually getting quite a bit of reach, and it's broadcast live on Facebook and YouTube and that kind of thing now, too.
Great. I'm going to check a couple of things while you're...
I better get a Kleenex. I got to blow my nose. Hold on.
Okay, no problem.
Sorry.
We have 3 minutes, I think.
This is my second one today, Peter.
Really? Who else?
I had another one. I wasn't the one. I wasn't the main one. It was another panel on pandemics that I did earlier than this for like an hour. I do like 2 a day, something like that. I mean, my show's every 2 weeks.
2 a day?
Yeah.
Oh, that you do?
Yeah, mine are every 2 weeks, but I'm involved in anywhere from 1 to 3 every day.
Uh-huh. All right, good.
Okay, 1 minute.
All right. So do you want me to talk about any of the recent wins with Accolade and Relayer and things like that?
Absolutely. Okay, here we go. So welcome everybody. My name's Gary Fowler, and it's great to have you again on our show. GST presents Silicon Valley AI and Technology. So today, it's my great honor to introduce my friend and legend, Peter Loukianoff. Peter, it's great to have you today.
Thanks, Gary. I don't know about the legend part, but I'm glad to be your friend.
Yeah, so Peter is an amazing guy. He's got 20 plus years experience as a business innovator, a leader in Europe, Silicon Valley, Asia. I mean, he's worked with companies that have been bought by Skype, Quick, NASDAQ, exactly, Yandex. I mean, you name it. I mean, I think I'm going through the whole alphabet, Peter.
You just don't have the Z in there yet.
And Silicon Valley Data Sciences. I mean, Maz Capital Partner, one of the premier VC firms in Russia, he was involved with. So, and now Strawberry Creek Ventures. He's a speaker. He's written articles in places like the New York Times and Wall Street Journal, CNBC. So, with that, Stanford, he's spoken at Stanford University, and he earned his MBA and BS from the University of California at Berkeley. So, Peter, it's amazing. I got it all in.
Thanks. Well, it's nice to be here.
So, Peter, tell me a little bit about, so from your perspective, what's happening right now? We had this pandemic, and it's changed a lot in the last 6 months. Where are we today?
Boy, there's so many different layers, there's the pandemic issue, there's, politics going on, there's all sorts of other issues happening. But I think when you sort of step away from all those things at the end of the day, I think there's great opportunities out there to build companies. In fact, every single time, and I was a very young venture capitalist when I lived through the 2001 sort of crisis that we had in the US, and that was mostly around the dot-com bust and the telecom bust and so forth. And then in 2008, I co-founded my last venture fund, and we were in the middle of fundraising, and that was during the global financial meltdown. And now you've got this situation. But in every prior time, that was right after these crises, or even during them, is some of the best times to start a company and invest in companies. And you look back and companies like Uber and others that were sort of born during the during crises. These are opportunities for great companies to be built. So I would really encourage entrepreneurs that even though things are bleak out there from a macro environment, that's these things are all cyclical. They all go through cycles. And it has to sort of even out at some point and change direction. And I would say this is a great time to be investing and building companies.
Yeah, I mean, I was just on a panel in Hong Kong a couple of days ago. One of the things we talked about is through this digital transformation and how mediums like Zoom have actually allowed us to be able to do things quite differently than we've ever been able to do before. And in fact, if you look at Zoom's users, it's gone from 30 million daily active users to about 300 million.
Yeah.
So, I mean, think about how this has really changed the fabric of our existence. So these companies that embrace the digital transformation, the startups and VCs, imagine the opportunities for them.
Well, that's the thing. I think one of the hardest things for an entrepreneur or company to change is consumer behavior. And what's happening now is consumer behavior is changing because of the pandemic and other things. And if a startup can sort of catch that wave and get into that change and leverage that change for its own product, like a Zoom, I mean, it's a perfect example, but I'm sure there are others. At least in the US here, there's all the telemedicine, telehealth, all that stuff is really booming. We're seeing it in our own portfolio, digital health, fintech, anything having to do with enterprise efficiency and productivity is doing extremely well. So again, there are these pockets, and I think that a smart entrepreneur can sort of see that wave coming and see the changes in consumer behavior and take advantage of that, because that's, like I said, it's the hardest thing normally to change in a market. But when the market is changing like this and you have these dislocations, it really creates tremendous opportunity. So I think an entrepreneur needs to sort of step back a second and sort of not get caught up too much in all the bad news and mire, and really look at what are the trends. And there are going to be tremendous companies and opportunities built from this situation in the market. I agree.
Yeah, and you're right about it, right? Part of the being an entrepreneur is keeping that positive attitude and move forward. Visualize where you want to go, really focus on it. And if you focus too much on the noise, you're not going to be successful, because you're so tied into what's happening, you forget where you're supposed to go.
Well, that's the thing. There's always a reason not to do something, and you have to just find the reason to do it and make it happen.
Well, you've known that. You've seen a lot of stuff, Peter. I know you've worked in Russia and other places. You've seen ups and downs and ins and outs.
Yeah.
So tell me a little bit.
I think actually, Gary, that's an important aspect, actually, that the ability for, I think entrepreneurs can sort of benefit from our experience. We've been around for a while and have seen these ups and downs. And I think you just sort of need to say, chill out. It's going to happen and the world's going to do its thing, but I'm going to do my thing and just focus on that. Because it would have been very easy, for example, in the 2008 crisis and the global financial crisis, for us to quit at that time. There's all sorts of reasons not to do it, but we persevered through it. And then it turned out 2009, 2010 were some of the best times to be investing in building companies. And we, have a lot of, fruits from that at this point. But it would have been very easy to just quit. And so, but that's not a word I know, and just, keep plowing ahead. So I think that's very true.
Yeah, you're one of the most resilient guys that I've known. I've seen you through the ins and outs and ups and downs. But that's part of it, right? And that's the difference between being successful and being a failure. The people that really dig in and believe in themselves, believe in what they're doing, they move forward. Look at the startup. It's never easy, Peter, is it?
No. In fact, I when I was in business school, I remember there was a case study that talked about startups and the different changes they have to make. And on average, the average startup makes 3.2 changes to its business model until it figures things out. So it's normal to fail, to change, to fail, to change, to make some adjustments, and then you finally get it right. But it takes that iteration, and that's where perseverance and not quitting, being positive, and continuing to ask, how can we do better? What can we do? And that just sort of, the great entrepreneurs can do that. The other thing, one of my mentors, John Scully, actually, who wrote a book about, it's called Moonshot. And if you're an entrepreneur, definitely worth getting John's book. But he talks about this idea of zooming in and zooming out, and being able to zoom in on the details, but be able to zoom out and sort of see what's going on more broadly in the market. And sometimes entrepreneurs can only do one or the other, or they train themselves to do one or the other. But I think any great entrepreneur, and you can train yourself to do this, is be able to zoom in and zoom out. And he talks about how Steve Jobs actually was great at that. He could get into the details, but also can zoom out and look at the broader picture. And so, and that was a developed thing. I think over time he became better at that. But John talks about that a lot. And I think that's a really important trait for entrepreneurs, to sort of train themselves to do the zoom in and zoom out, and be very good at both ends.
Yeah, and you're right. Speaking about Zoom, right?
Yeah, that's right.
No, I agree with you 100%. I mean, that's part of it. Looking where the trends of the market are, and then being able to drill down in a micro level to understand where your business needs to go, and tactically getting it done. Absolutely. So you've had quite a few successes recently, right? You have SVDS, and you've had Accolade, and you've had. So tell us a little bit about it. We want to hear all this good news.
Well, yeah. I mean, my prior. So I've been an entrepreneur, then became a venture capitalist, then became an entrepreneur again, then became an entrepreneur venture capitalist when I started my venture fund, or co-founded it back in 2007. And then after selling my interest in that, sort of went back I did a little work at McKinsey, and then ended up going back to start a company called Silicon Valley Data Science. So we started that really based on an idea that this new thing called big data was coming around, and our thought was a lot of the big companies didn't really know how to deal with this stuff, and so we were going to create a company that would help them figure that out, and to create products around data science products, and have teams of data scientists and data engineers who could solve these various problems for them. And the big sort of, I think, aha moment for us was that a lot of the companies we interviewed, and this again took us going out and talking to customers. I know you mentioned that a lot. Entrepreneurs need to go out and talk to people and understand what's happening in the market. And the thing we found was that there's just this pretty clear need at that point. Now, this is already a number of years ago, but there's a need at that point that especially a lot of the retailers were saying, I don't know, we don't know how we're going to compete with Amazon. Amazon's going to kill us. We need to become better at data science and data, because we're a traditional merchandiser, but they're really a data company. And we need to learn how to manage data and work with it, but we don't have the people, we don't have the methodologies, and we just don't know how to do it. And so that's where the idea really came from, was after listening to the market and understanding what the pain point was, and the fact that they weren't able to fix this problem, that we were going to go out and do that. And so, so we created Silicon Valley Data Science. We eventually sold it to Apple, which is a good outcome. I think, we could have built it into a bigger.
I think you're smiling. It must have been a great outcome.
Yeah, it was good. It was and no complaints. It was very good. I mean, I would have liked it to go public, but that's okay. And then after that, I co-founded, or I founded actually Strawberry Creek Ventures, which is a group of university alumni funds. So here in the Bay Area, we have Berkeley, Stanford, UCLA. We've got on the East Coast, we've got MIT, Harvard, Dartmouth, schools like that. So we've got about 18 different schools as part of this network. And we've recently become one of the most active, according to PitchBook, venture capital firms in the U.S.
You mean, is that just your part, or is that the entire group?
No, that's the entire group. Yeah, but we're a big part of it, but we're one of the sort of the leading groups within that. But I would say that, as a whole, we are, a pretty significant, venture fund now. I mean, I think we were ranked number 3 in terms of most active VC firms in the U.S. And so, yeah, we've been pretty active in investing. I would say that with this whole COVID situation, the companies that have struggled are ones that sort of relied on the Asian supply chain and had some issues there, and still are challenged by that. But the companies that are flourishing are all these ones I mentioned to you, fintech and digital health and any kind of enterprise kind of efficiency companies. But yeah, we recently took Accolade public, which is a health benefits services company that's doing really well. We sold a company called Relayer, which is based in Berlin, Germany. We actually invest all over the world. So Relayer was in Berlin.
Fund, Peter. How big is a fund?
Well, we've got about $500 million under management right now.
Mm-hmm. And so how does somebody come in? So the startups watch my show. How do they contact? What are the criteria for them to come to you to say, hi, I've got this great idea?
Yeah, so we have a little bit of a unique positioning. So in my prior life, when I was a partner at Alloy Ventures and my other venture fund that I co-founded, I was always sort of a lead investor. So I would go on the boards. I would go very deep into companies and maybe do 1 to 2, maybe 3 investments per year, and that's it. This firm is built a little differently. So for our investors who are high net worth individuals, what we do is we provide them with basically access to the venture capital category or asset class. Mm-hmm. And basically with one check, they get diversification across different geographies, different sectors, and different stages. And so it's meant to be almost like think of it as a mutual fund for individual investors who want to invest in venture capital. And we leverage our great relationships to get into deals with phenomenal lead investors. So we've done a lot with Excel Partners. I just showed recently a deal to Sequoia Capital. We did Relayer, for example, that was with Kleiner Perkins. Accolade, that was a deal that was headed by Andreessen Horowitz. So we follow these top tier venture funds into these companies. And so we'll do a lot of deals, but fewer dollars per deal as a result because of this. What we're really shooting for is to provide diversification for our investors. So as a result of that, in this role, I'm never a lead investor. I'm never taking a board seat. I'm always only following other top tier VCs. But what we can do is we bring and we leverage a very sizable alumni network from all these top schools across the US. And we have close to about 500,000 alumni right now that are members of our network. And so we leverage this network to help our portfolio companies with things like recruiting, customer introductions, digital outreach and marketing, that type of thing. But we do it only as a follow-on investor. So in order, you asked about criteria, for us to invest, we have to have a top tier lead investor leading the deal. And then we would come in and sort of fill typically up to 15% of a round. But we've done as small as $50,000 checks in a seed deal to like $10 million, up close to $10 million kind of check for a later stage round. But it really sort of depends. Again, we're pretty broad in our application.
Interesting.
But I'm sorry, Gary, I would just say that if an entrepreneur, if they're early stage or seed stage, we do have a couple of seed stage funds that I can refer them to. And so if they're a seed stage company, they can just email me, peter@strawberrycreekventures.com, and I'll probably forward it to one of my teammates who focuses on seed stage. And then if they're a late, more like a Series A or beyond, what's that?
What's the seed stage? Just for the audience, you need to find what that is.
Typically, the first money in. It's the first check typically.
How big?
First few checks. I think that our seed fund is done. We've done as little as $50,000 checks, but our seed fund can do like a $25,000 check or something or more. But it's in that range of, it's typically under $1 million. Again, all these things have changed a lot in terms of the nomenclature. It used to be, Series A were $1 million checks, and today that's like pre-seed or something like that. So anyway, it's all changed. But
$100 million for the seed, and then what's the range of your other funds? So if you do the follow-up investing, what's the range? 1 to 10 or?
Yeah, about that, or even $500,000 to 10, something like that.
Okay, all right. So Peter at one more time, Peter, so they know. Peter at
strawberrycreekventures.com.
There you go.
I know there's a lot of people online, so if I get flooded with emails, I may have to take a little while to get back. But yeah, I'll at least forward it on to our team.
That's great. All right, so in terms of the investment, you've gone through that. You've done Accolade. You've done SVDS. You did, it's curious. You did Quick to Skype a few years ago. How big was that deal?
I think we can talk about it now. That was about $150 million, but that was actually it turned out being a great IR because it was a very short, investment. So it was a phenomenal return from that standpoint. But it was great. It was good to be on the board of the company and support the entrepreneurs there. And they were a great team actually out of Zelenograd.
Wow, interesting. Peter, so I have a question for you. I've got a question here. What do you look for when you're going to do investment in a company? So what are the 3 things that you look for? What's the most important thing when you're going to invest in a company that you look for?
Well, there's some, I think, there's some debate over what is more important. There's basically 3 elements in essence. The people, the technology, and the market. I think I used to be more focused on just the people, but I've sort of come to understand that the market actually, if you got great people, but you're going after a tough market, that's always difficult.
Mm-hmm.
So I think that I've sort of come to realize that this whole idea of the rising tide lifts all boats kind of thing,
right,
is an important thing, right? And I saw this a lot in my career where you had, and what's funny, I think every venture capitalist who's actually been in venture for at least a couple decades will tell you this, that they'll see a deal that looks, it's a certain type of company, and that company fails initially, and then that same idea, the same company starts up again 5 or 10 years later, and then it's a booming success. And what's the difference between that? Well, it's just that the market was aligned. Like, and surfers sort of know this intuitively, right? If you're too far in front of the wave comes and crashes on you, right? And you don't really catch the wave, and you've blown it. If you're too far in back of the wave, you sort of miss the wave, because the wave goes in front of you and you're in back and you miss that. So the idea is you want to be right in the middle and have that timing right, where the wave is really pushing you in. And so I think the same thing can be applied here with venture and markets, where you want to, I think the market timing, although we don't necessarily time markets, but we do think about, I ask a question a lot, is what's changed, right? So I often ask the entrepreneur, what's changed in order for you to be able to do what you're doing? And that's sort of a test, right? Because if they can tell me, well, here's what's changed, and here's why we can be successful, and here's why the opportunity happens, then that tells me an entrepreneur is sort of in tune with the market and this wave, right? Because if they have no clue and they're just sort of making stuff up and they don't really have a basis for it, it's somewhat hard. So I ask that question a lot. It's like, what's changed, right? And so I think market is probably the most important thing. I think
so market number one,
be a close second, if not first.
Interesting. And number three, so timing,
the technology. It's the product and the technology. But again, if you don't have great people, you can't take advantage of the great technology, right? Because if you have great technology but lousy people or lousy market, nothing's gonna happen. So, and again, the markets can change a little bit. So sometimes a technology is so hot that people will just pay for the technology. But generally, I think the market sort of is number one. People either number one, tied for number one, or number two, and then technology after that.
So TPT, technology, people, timing, right?
And you'll get different people that might disagree with that, and that's fine. But
that's great. I mean, I like the analogy. I agree with you too. I mean, timing. Look at MySpace. I mean, the timing is everything.
Yeah, exactly.
You could be at the right place at the right time or the wrong place. Yeah, you have great technology. So I agree with you.
And by the way, Gary, the other thing, sometimes it's little tweaks in product. Like, I mean, that's a good example where it was more of an insular product, and you had Facebook come around and they were sort of very open and allowed the network effect to work, and then sort of took it by storm. But there are plenty of examples like that where the entrepreneurs need to be smart enough to figure out, okay, I got, and that's actually an example where the market was there, so that was all good. But it really took the entrepreneurs to really maximize the opportunity, where one didn't as much and the other one really did. And it's little tweaks and sort of, again, listening and being smart enough to figure out, where do you zig and zag to going back to that, business plan, 3.2 times the changes. You got to sort of sometimes make some changes and adjust to the market.
Yes, no, I agree with you. And so pivots are really important. You got to be able to do big pivots, as you had said before, where you got to really drastically change the course of the ship, or you got to have those little pivots and keep as my partner David Yang would say, course correct all the time.
Yeah.
No, I agree with you. So in terms of the market, so if we look to the next 6 to 12 months, what do you see, Peter? What's out there today? So I'm a startup coming in to see you. Got incredible AI technology. What do you see in the next 6 to 12 months? What's going to happen? How is it different than it was last year? What do you see for the future?
Well, AI is sort of becoming a little bit, I know you're probably not going to like my analogy here, but it's becoming a little bit of a joke in the sense that everybody's an AI company now.
Yeah.
It used to be a liability, by the way, because one of my first startups back, I'm dating myself, but going back to like the late 90s, it was we were using AI, but it was very rudimentary kind of stuff, and the hardware really hadn't developed at that point to be able to use it. So AI has been actually around for a long time. So back then it was actually a bad word because it wasn't, it didn't work very well. And then now, like, everybody's using it. So I think most investors just expect it to have some element of AI, but I wouldn't overmarket that aspect to it, because you just expect it to be there, just like software or anything else.
Well, I mean, but Peter, a lot of these companies that I've talked to say they have artificial intelligence, when in reality, big math. It's not. There's not AI. It's not neural networks. Not an element of AI. So you're calling it AI when it's really not. So I think
and that's where they're going to lose credibility, right? If they do that, right? So I think you have to be, number one, with your investors. You have to be totally honest and truthful with them, no surprises, and just lay it out to your investors. And I think that's always important anyway, just to be forthright on stuff, because once you try to monkey around with that, and if it's not what it is, you'll get called on it, and it's not a good outcome. So I think just being straight up on it, and it's okay to be different. Nowadays it might be different to say, hey, I don't have AI, but I've got this, or whatever it happens to be. But certainly I think there's so much to do in this field, because, like I said, I think a lot of things are going to be based on AI now, and especially with a lot of the new hardware assist that's coming in. In fact, we just closed a deal yesterday. I can't really talk about it yet, but it can potentially dramatically change the whole compute landscape. And so there are things like that happening, where there's underlying infrastructure that is being invested in today that could dramatically change things. Down the road.
I'm curious now, Peter. You should have said I can't talk about it. See, I knew you were trying to set me up for that thing, because you wanted me to be more curious.
We'll get GSD involved at some point. So here's the deal. So a company comes to you, and let's paint the scenario. They say they have artificial intelligence in them, and what do you do to do the due diligence to check? How do you validate that what they have is real or not? And I'm talking about some deep tech. How do you do that? What's the process like for people? Yeah, well, I'm an engineer by background, but I don't pretend to be, the smartest AI person out there. I mean, I've got enough background and question to ask some specific questions around it, but I'm not gonna, I'm not gonna be the one doing the deep dive. I'll get one of our, our experts to do that for us. But at least I know sort of some of the questions to ask, and they would be around, I think understanding the data sets. For example, one thing, for example, that we learned at Silicon Valley Data Science, it's a lot of this, garbage in, garbage out. If you don't have good data, your result is not going to be good. So a lot of it is what's the data pool? What data are you ingesting? Things like that. In voice applications, for example, there are things that are called, grammars, for example, and you can have a grammar-less kind of system, or grammar-based system. And so, how are you managing those grammars, and how, again, it's the underlying data and how the algorithm is accessing that data that is sort of a critical thing. So I look for those type of things. But beyond that, I think we get our deep tech people look at it, and they'll help us with the technical diligence. But we'll poke around, and sometimes what investors do, and I try to do this as well, is ask the same question but in different ways, and to see if I'm getting a consistent response or not. And so that's another sort of element of figuring out, is the entrepreneur being straight with me or not. And I always sort of prefer to just sort of read the entrepreneur and understand where they're coming from. I think a lot of one of my other questions is, what's the genesis of the company? What was the aha moment for you? What was the light bulb that went off and said, hey, this is a great idea. I got to go do this. And a lot of times that will tell you a lot about where the entrepreneur came from, and do they understand the underlying problem, and what did they see that made them innovate on whatever they're doing, right? And that will sort of give you clues in terms of understanding the true innovation of something. And so, there are just things like that I've learned over the years, just asking the right questions. And I actually think that's a great skill that a lot of the universities actually don't teach and should be taught, is just great questioning skills. And so I use that a lot in what I do.
So I got a question for you. So you've got a startup come in, and they're a bunch of technology guys.
Yeah.
And they come in and they're solving a problem. How deep do you look into their financial model?
Well, most startups don't have. If they're really early stage, they're not going to have much. And what you're looking at there is trying to understand, at a minimum, again, the market size, what will customers pay? Because a lot of times what sometimes entrepreneurs get thrown off by, especially if they're selling to large customers, is that some of these large customers will try anything once, right? But the entrepreneur gets a PO from some big company and they're all excited about it. But well, does that really mean that they're going to buy more or not? Or are they just testing this out? And that will happen a lot, where you have a false indicator where the entrepreneur thinks, oh, this is going to lead to X, Y, and Z, but they haven't really done their homework to really understand that customer and how broadly their product can be deployed there. So I think having the entrepreneur understand that and be able to make a case of why they're able to really penetrate these accounts is I think a key thing. So I look at more of the assumptions rather than the model per se, because the model can be fiddled with. But if you look at the the margins and on a product basis, what are the margins, and then understanding how the entrepreneur is planning to sell into that account, that's probably more valuable to me. And then I can sort of reconstruct the model, because almost every single model that I've seen is never takes place, and with very few exceptions does it actually exceed what they're planning. What's that?
Wishful thinking?
Yeah, I know. Yeah. But you got to shoot for something. And then, but the thing with models is that we hold management accountable for those models, right? And so they've got to deliver on those numbers. And if they're not going to deliver on it, they're at risk of not being CEO anymore, if that's the case. And actually, this brings up another point. It's a little off topic, but something that one of my former partners at Alloy Ventures did, and he was really smart about doing this. So he was a very successful entrepreneur in the life sciences space, and he helped build $1 billion company, maybe two. I lost track already by now. But he said, that he was the CEO early on, and he co-founder of the company, and he took it to a certain point. And then he realized that it's going to be really hard for him to scale beyond that. And he was smart enough to fire himself and bring on another CEO. And then he ended up basically seeing 2 or 3 more CEO transitions before the company went public. But he stayed as chairman of the company and saw the company all the way through from its founding to its IPO. And he actually made more money from his option shares than his founder shares. And I thought that was a great lesson, that if you continue to add value over time, you're going to get rewarded. And the investors want the entrepreneurs to be part of the company going forward, because they're sort of the lifeblood of the company. I certainly do that. But sometimes you get entrepreneurs that fight with you and make it difficult. And sometimes they're right, but a lot of times they're wrong. And there are very few people that can be like Bill Gates or take things all the way. So you got to be smart enough to realize, hey, when should I replace myself and then bring somebody else on? And so in his case, he ended up doing great with that. But again, they continued to expand the pie, and that pie got larger and larger, and he again made more money.
He got a little slice of a big pie.
Yeah, that's the key thing.
Yeah,
and everybody's happy. And by the way, the next time the investors will even more readily, they'll be throwing money at you to go start another company. You know? So entrepreneurs also need to be smart about that. That's the other thing I've sort of seen where entrepreneurs make the mistake of, they sort of only view things as today, right? A lot of entrepreneurs are probably going to start 2 or 3 companies in their lifetime if they're young enough, right? And they've got an opportunity to do that. If you've got that entrepreneurial bug, you're going to want to do that several times. So the best thing that we like to do, when I was at Alloy, for example, we thrived on backing serial entrepreneurs. So every entrepreneur that we backed, my hope was that we were going to have 2 or 3 or 4 deals with them, that we can back them. And one of our founders actually, and I was, again, very young. I just asked a lot of questions back then. I didn't know much about anything. But I asked him one time, I said, Larry, and this guy was very successful in the storage business. And I asked him, well, you've done a few deals now with Alloy. This is your 4th company. How's it been? He goes, well, the first deal, they got the better of me. But the last deal, I got the better of them. And it all sort of evened out. And he created 2 billion plus companies and was very successful in that space. And they had a great relationship for a long time. And so I think as an investor, that's what I like to do, is look for these serial entrepreneurs and be able to back them and develop a relationship with them. And maybe on the first deal, maybe I get the better of the deal, right? But the next deals, they'll get the better of it. So anyway, that long-term relationships are important in this business.
The most important, right?
Yeah. Well, that's another thing I was just mentioning. Another company I'm looking at this week. We had I won't mention the firm, but it's a very top tier firm. But I knew the partner when I was back at Alloy, and we had a good relationship then. And I hadn't seen him for probably 15 years. And so the CEO, when he started this company, called me up and we connected. And it turned out that this guy, John, was, an investor in his company. And I said, gosh, I haven't seen John forever. It's like, I don't know if he'll remember me or anything like that. And then the CEO put us together and he's like, oh, yeah, I'd love to connect with Peter. It'd be great to co-invest with them. And again, sometimes, you go through these battles way back when, but the valley is very small. And I think the world is generally very small. And to be able to have, good relationships, that's really important. And I've had some that I've totally screwed up as well. So, that's, lessons learned. But generally, that's a great thing when you can have that type of thing where 15 years later, somebody has a good recollection and wants to work with you, right? So that's a good thing.
Yeah, so maintain those long-term relationships.
Yeah.
So we have companies from China, companies from Russia, companies from Israel. What are if you could give them, advice, what would you say to these companies from around the world that want to come to Silicon Valley? What, just talk a little bit about it. I mean, from your perspective, what do you do and how do they get there and how do they find somebody like you and how do they get set up? Let's say they're a growth stage company, they're dominating a regional space. I mean, what do they do from your perspective to be able to?
I think they call you, Gary. I mean, that's GSD is great at that. And I think that's, you do a phenomenal job.
I'm honored.
Seriously, that's what I tell entrepreneurs that, like, if they want to get, do the cross-border thing, they should call you and you can help them. But what's that?
No, go ahead.
No, please.
What I was going to say is that, and I just wrote this article in Medium. There's really like 3 different levels, right? There's acceleration, there's regional domination, and there's a going global thing. And especially with the pandemic today, it's not so easy if I'm in Mumbai or I'm in Stavropol to be able to go global. It's not so easy to do it was before. So one of the things, and I just had a panel earlier with my friend Kyle Ellicott, and what we did is we looked at that. It's not so easy to go out, and this digital transformation has really changed it, as we said earlier, right? It gives you a chance to be able to really go out to the market in an entirely different way because now we connect, as we are in StreamYard now, on Zoom or whatever, we can connect, where before people wanted to meet in person at Hobie's. I can't tell you how many breakfast. I think you and I've had a few there.
Yeah.
A lot. meeting at places and having breakfast. But those, for the foreseeable future, that isn't going to happen. So now, if I'm coming from a Mumbai, so one of the things is, if you look at those entrepreneurs, they have to think differently, right? They have to think about going global. How important is that for you in terms of the vision of the CEO of the company? You said in terms of knowing where they have their limitations, but how important is it for you to have them understand that they need to think differently in terms of, not being just a regional player?
Well, I think to be, venture capital is all about the home run game, right? We're taking a big enough risk already that we want to be able to invest in companies that have a big opportunity, global opportunity. And so I think it's important, but I think it's one of those things where you got to balance. You can't get too defocused.
Yeah.
And you have to be smart about how you go about it, because it can be really expensive to go global too, right? And so I think it's the timing issue. It's relationships you have around the world. It's all sorts of things. I mean, I can just, going back to my experience, at least in Russia, for example, I mean, the great thing we had there was super smart people. They were competitively priced relative, and that doesn't mean that they weren't making good money. They were making good money for a local, but on a global basis, we didn't have to pay Silicon Valley salaries because everything's a bit inflated, unfortunately, in Silicon Valley. But that's the advantage, for example, Russia had, and still has, I think. Really smart people, reasonably priced, and also extremely creative. I think some of the creativity that we got, I mean, Quick, you mentioned Quick before as an example. That was a company of video application that essentially competed with FaceTime. And if you use a Skype mobile today, basically that's or any Skype video product, that's basically the Quick product. But this was done on a fraction of the budget that Apple, for example, spent. And we had a very comparable competitive product, if not better. And it was a great investment for us for a lot of those reasons. But it was the fact that, and they were able to make it work, where they were sort of initially started in Russia, developed the company locally first, got some traction, had worked out a lot of the technical kinks. And that's the thing. I think it would have been premature for them had they not worked out all the technology and product first. And then later on, they ended up opening up an office in Silicon Valley, and they had a Silicon Valley-based CEO who also sort of understand the global landscape and did a great job with that and raised money here locally and all that. But we basically had a headquarters in the U.S., the engineering team back office in Russia. And a lot of companies are like this. I mean, look at Ring Central or Five9, and there's so many like that. And the same, like in Israel in particular, a lot of great companies there as well from that standpoint. Other countries are doing the same. But I think the key thing is just, I think, understanding what the right timing is and then when to do it. And that's a sort of a broader, it's hard to just like say one thing that will work or will not. But I think that's where, the investors want to know that the entrepreneur has thought through things well, right? And understands, like when we put our money in, we want to make sure that money is not sort of spent, in an irresponsible way. And in the early stage, you expect money to be spent on technology and lots of iterations and trial and error, but it's very focused on that, right? When you are ready to go to market and you're thinking, gee, I'm ready to go to Silicon Valley. Well, what does that mean? Understand the cost, understand how are you going to operate? You have to think through all those dimensions, because to your point, especially now today, it's a lot harder to do that, right? And so maybe it's better in this environment, just focus on your local market, gain more share there, and then come to the U.S. later. But it's hard. I mean, every case is different, but hopefully that gives you some perspective.
No, I think it's really really interesting. And in terms of revenue, if you have, let's say you have, the same startup, how important is it to have revenue? So let's say, you've got similar technologies. One's got $250,000 in revenue a year. Another one is just getting started, and has not generated revenue, and they're relatively at the same stage. How important is revenue?
Well,
Does that?
Yeah, sometimes actually revenue can hurt you, oddly enough, and that's because when you're starting to generate revenue, you're going to be judged more on the financial numbers versus the technology promise. And sometimes it's easier to raise money before you become a financial company and more on the promise of the technology or the growth of your whatever your user base or something, if it's a if it's a internet product or something like that. So sometimes actually it can work against you. So I think the things that I always encourage entrepreneurs to do is create a milestone chart. And a milestone chart basically says, okay, at time 0, when I'm starting now, to the next, call it 3 years, because it doesn't make sense to go out to 5 years, really, too much will change. Or you could, perhaps, but it's really hard to forecast beyond that with a startup. But you basically put in what milestones are you going to achieve, right, through that, say, 3-year period or 4-year period. And then you have, on the bottom, you have a cash line. How much cash am I burning? And then you're showing like revenue, for example, as well. And you have to be smart enough to understand, like, certain investors won't touch a company if it doesn't have 10 million plus in revenue. But those are like the later stage investors. But once you get to that point, it opens up a whole new universe of investors for you. And so instead of having the universe that big, you all of a sudden have a universe that big of investors. And it makes a huge difference when you go out to fundraise, for example. So the reason I'm mentioning that is an entrepreneur needs to think about these milestones and what's a fundable milestone, right? So, for example, if they could have raised an extra $1 million and they would have gotten to the 10 million of revenue, it would have been worth taking that extra $1 million here, because you're going to open up that universe a lot more widely when you get to that that milestone point. And whereas on the other hand, if you were too short, if you didn't take that $1 million and you only got to whatever 6 or 8 million of revenue or something like that, it's a different it's a different deal at that point, and you may not be able to get high enough step up in valuation to make it worthwhile. And that's the other thing we look at as early stage investors. When I do an early stage deal, I always look at, hey, if I invest now, is it going to be worth my risk, right? Because oftentimes you have entrepreneurs showing you a plan where you invest now at a very risky stage, but you're only going to get like 1.5 or 2x at the next round. Well, I'd rather wait and take a bet at the next round and let somebody else take the risk in the early stage. So that's where an entrepreneur really needs to think through, these milestones. And when I say milestones, fundable milestones. And if they're savvy enough, they will understand from an investor point of view things like what I just talked about. That when you hit 10 million of revenue, you've got a whole new universe of investors you can go talk to. Or if I get so many people in my, my whatever, if it's an internet service, if I get so much growth, for example, in users, I'll be able to get these type of investors. And knowing the venture market, that's where entrepreneurs sometimes fall short. And I think they need to be smart enough to understand, what are investors looking for and how do I plan this out so I raise the proper amount of money to get me to the next fundamental milestone that's going to make an investor coming in at an early stage being willing to take the risk and getting paid for that risk, right? Because if I can make, say, 3 to 4x from the Series A to the Series B, I'll do that deal every day. But if it's only 1.5 to 2x, I may not, and that will make it harder for an entrepreneur to raise money.
I see. I got it. And so what you're saying is, once you start to grow, you really need to start to grow, because once you're in non-revenue, it's a lot easier sometimes to raise the money. Interesting. Wow, that's
and by the way, that applies to an IPO too, right? So when a company goes public, what's important is the steepness of the curve, right? It's that derivative. What's the steepness of the curve? And if you're sort of just growing like this, well, that's not very interesting. But if you're showing a steep curve, maybe it's backwards in my video here. But anyway, if you're showing a steeper curve, that's what you're going to get paid on. That's why IPOs of growth companies, Amazon, they didn't care about profits. They cared about growth, and they got paid for that, right? And so investors invest in growth, and that's, especially at the IPO level, you're looking for that. And I think the same can be applied in venture capital. You're looking for that, the steepness of the curve. How fast is it growing?
That hockey stick.
Yeah, that's another way to think about it.
Okay, so we're just about out of time, Peter. So closing thoughts in terms of advice for startups out there. What are, if we're looking at the future, we're looking at the next year, what's important for them now to focus on, and what do you think is going to be important for them over the next 6 to 12 months?
Well, I think the key thing is stay positive. Number one, there's going to be a lot going on in the U.S. with this election that we've got coming. There's so much, noise out there and all this stuff going on that you almost have to ignore it, because I just stopped watching the news. It's just too you get caught up with all this stuff. And I think for entrepreneurs, you got to focus on your business, stay positive, because everybody will tell you no, everybody will be negative. You got to just stay positive. So that's number one. Just stay positive, persevere, take care of yourself, your health, because if you're not healthy, nothing else matters. So make sure you're taking care of yourself, and take some time off if you need to go spend some time with your family, or just take care of yourself. I think that's a good thing to do. And then you'll work harder later. But if you burn yourself out, it doesn't do any good. So make sure you take care of yourself. And then I would say the other thing is have a mentor, right? I think a lot of entrepreneurs sometimes go about things a little blindly, and if you have a mentor that you can go to and talk to and bounce ideas off of, I think that's really useful and helpful, because a lot of times a good mentor will have made a lot of mistakes in the past and can prevent you from making those mistakes. And so time is short. You want to sort of move quickly through things, and having somebody there that you can rely on and call upon and be able to share. And by the way, this probably should not be a board member. It should be somebody completely outside of your company that can give you, totally, fair advice and objective advice. So
Okay.
I would say those things.
No, that's great. That's fantastic. Well, Peter, I want to say thank you so much for taking your time out of your really busy schedule to spend time with us today. We appreciate your keen insights, and we really appreciate your advice today. So thank you.
For you anytime. But I also, I just want to say that I was an entrepreneur. I guess I still am to a certain degree. And so I know how hard it is, and I can empathize on how hard it is. But you just got to stay positive. Just keep plugging away, make it happen. Because entrepreneurs, I think, can change the world in a positive way. My personal view is we need fewer politicians and lawyers, but more engineers and entrepreneurs. So anyway, go do what you're doing. I think it's great.
Yep. All right. Thank you, everybody. Appreciate you taking time out of your schedule to be with us today. Passion, optimism, visualization, get stuff done. Go get them. Stay positive. Thank you very much. Thank you, Peter, for your time.
Thank you. Goodbye, everybody.